Hello, everyone. It is so very good to see you. My name is Mark Dolfini of Strategic Boardroom. It's good to be back. So we're trying this again. We had a little bit of technical difficulties and some uh, just ridiculous people being doing ridiculous things on my last feed. So I ended up shutting that down. Here we are. We're back. So thank you all for those of you who sent me some messages. They were a little frustrating as well, but it's good to see you guys. So I've been flying kind of solo on these just because I initially had some moderators, but I had my moderators doing some other work. And anyway, so we got moderators back to kind of police the room a little bit better, and we're pretty sure we worked with the folks at EventBrite, and I've got a message into the guys at StreamYard. So I'm just really good to have good quality companies that understand what it's like for us as content creators and teachers and educators. Once we're putting stuff out there, we just don't need this sort of nonsense. So it's really really good to see you. Yeah, it's very good to see you too. Thank you for stopping by. Living life with FND. Thanks for stopping by. All right, so we are. So if you are joining me, go ahead and let me know what line of work that you're in, and maybe where you know what kind of issues that you're having with financial literacy. That's really what the session is going to be about, is financial literacy for business owners. So if you've got some issues that you're thinking like, man, if I could just get this one thing figured out with my finances, I feel like that would be the last domino to fall. Or I don't even know where to start. Well, we're not going to be covering all sorts of aspects of different financial literacy from a personal finance perspective, but how we are in one area is often how we are in other areas. So we've got Duffy McDuff. All right, it's good to see you, Duff. Glad that you could join me. So let me know where you're from, and obviously what kind of things that you may be struggling with when it comes to understanding finances. Today we're going to be covering a couple of different things that specifically around business finances, and that's what we're going to be covering today. So, it's going to start a business in 2 years. All right, very good. I love it, man. I love that you're being intentional. It's good to see you. All right, so yeah, let me know where you guys are from, and also what kind of businesses that you're in. So that would be helpful for me, so I can make sure that these are, as we discuss this stuff, that's it's relevant to you. All right, so let's get right to it. We've got a lot of information to cover, and again, for those of you who may be joining on different platforms, if you had signed up for this originally through Eventbrite, we're going to be sending that out to you. I just want to make sure that you guys knew. Once we get that scrubbed in terms of different, we're working with Eventbrite. They're blocking all sorts of IP addresses and so forth, and reporting those to the appropriate authorities and everything. Because yeah, it was pretty bad. But anyway, it's good to see you guys. All right, so let's get to the agenda. The agenda today is going to be around, first and foremost, we're going to be talking about the Viper methodology, and then we're going to be going through the 4 core functions of business. And then we're going to be talking about the financial statements, specifically just an exposure to what a balance sheet is, what an income statement is, what a P&L is, and those sorts of things. And then we're going to be saying like, dude, where's my cash? Where is all my money? And we're talking about a phenomenon called growing broke. And we're going through all of that. And then we'll be speaking specifically around different resources that can help carry you into different aspects of your business and in your life. These are all of the books that I have written over the last, let's see, 10 years now. Wow, I didn't think about that, but I started writing my first book in 2016, published that first book in 2017, so coming up on 10 years that I've been writing and publishing. So that's pretty cool. But the one on the top left, that's the Time Wealthy Investor. I'm not here to sell any of these. I'm not here to promote them. I just want to let you know how relevant the financial picture is when you start thinking about all these different things. Like, these things take money. They take money to do and perform, and obviously you want a return on that investment that you're putting into your time. So if the one on the top left is my first book called The Time Wealthy Investor. And for those of you who are interested in writing and publishing your own book, especially if you're a business owner, I cannot tell you how important that is as an authority, to establish yourself as an authority in whatever field that you're in. So again, I see a couple of other people joining. Let me know where you're from and what business that you're in so I can make this relevant to you. But the thing is, if you're trying to establish yourself as an authority, you can sign up on Eventbrite. Go there. There's a session that I'm having about writing and publishing a book as a business owner, and that is something that's going to be it's going to be totally free. It's going to be coming up in a couple of weeks. In fact, if you want me to share with you that date, give me just a hot second, and I can tell you where that date is. I have got all sorts of windows open. Man, I have got a lot of windows open. Who else does that? Like you have like probably so many windows open, like your browser just says, no, you can't have another window. You can't have another tab. Um, this is going to be Write and Publish Your Book. That's actually going to be on February 17th. And right now we've got some slots remaining. We're about a third of the way full. So if you would like to go ahead and sign that up. In fact, what I'm going to do, I'm going to put that link right in the session here. So if you want to sign up for that, you are more than welcome to join me on that. So that is that's a session right there. So we've got, let's see, Living Life with FND, Studying Real Estate Finally After a Couple of Decades. Hey, I'm glad you're getting started. Good for you. Was a medical massage for 2 decades before my stroke. Oh, wait a minute. I know you. It's good to see you. Sorry, I don't want to say your real name. I don't know if you want me to put that up there, but yeah, I recognize the photo now. It's really good to see you. Okay, so that's good. All right, so the link is up there if you are looking to. So I'm glad that you're studying real estate, and yeah, I'm glad to see you. Glad to see that you're back on here. So put together a really nice photo of me and my bride. Okay, and very, very talented, by the way. You do some really cool work. All right, so these are the books that I put the link up there if you are. Okay, Sarah, yes, I didn't want to say your name, Sarah, if you wanted to stay incognito, but I was just trying to respect your privacy. All right, so this is my latest book, The Time Wealthy Advantage, and the reason why I'm bringing this book up now is not necessarily to promote the book, but I just want to let you know that the premise that we're going to be talking about in that framework, that initial framework of the Viper methodology, that's what we're going to be talking about. So if you want to get in a deeper dive, if you're outside the United States watching this, if you're watching this on replay, my suggestion is go to Amazon and buy the book through Amazon, The Time Wealthy Advantage. If you are in the United States, the domestic United States, and you would like a copy of this, what I can do is sign it and send it to you. There's also some bonuses that you can add on there. Go to strategicboardroom.com. Again, strategicboardroom.com if you'd like a copy of the book. So you can find it right on the main page. Can't miss it. All right, so let's get to the Viper methodology. This is an acronym for vision, infrastructure, process, execution, and reporting. And this is a top-down framework in terms of how you look at your business and how you look at your life. So vision has 2 components, and vision is made up of both personal vision and business vision. So personal vision, from that perspective, personal vision is simply, where is it you want to go, right? Sarah, where do you want to go? John, where do you want to go? Rebecca, where do you want to go in life? As you're saying, hey, look, this is my vision for my life. This is where I want to go. And if your life wasn't defined by income generation, what would that look like? What would your relationships look like? What would your relationship with faith look like, or your friends, or your spouse, or so forth? Like, what would that look like if it wasn't defined by income generation, right? So think about that, and it's really important. The closer and more well-defined that you can have your personal vision, the more likely you're actually going to hit that. And especially if it's really, really defined. Get it really defined in terms of what you do want and really kind of what you don't want, right? But it's more important to define what you do want because, again, we're trying to fire up that reticular activation piece in our minds because that's what we're going to be seeking when we have it well defined. So that's important. And then the other component to this, we talked about personal vision. Next is business vision. It's like, okay, cool. Now that is defined, this is how we're going to get there. And that is why it's really important. There's many people who I have worked with over the years, and many people they hone in on the business perspective, the business vision, that they really don't give any sort of perspective to a personal vision. They're like, yeah, let me make $100,000 a month, and then I'll worry about that great life sort of thing. And the problem is they never get there. And it was interesting because I have sat in masterminds and conferences and so forth, sitting next to people who I know are legitimately like killing it financially. They're making 6 and 7 figures a month, like net take home, and they have all the toys and all the fun things, but yet they're miserable because their home life is miserable, their personal life is miserable. They don't have any relationship with faith that's meaningful at all. Their health is not great, or not where they want it to be. So these are the sorts of things that, because they have spent so much time focusing on a business vision and they've not given any consideration to a personal vision, is that they end up creating a life that exists to serve the business. Let me say that one more time because this is so important. The danger in creating a business vision, the danger in creating a business vision before creating a personal vision, is that you end up creating a life that exists to serve the business. And I'm just telling you, it sucks. It's like an empty well that just can never be filled in. When you start focusing on that personal vision and then reverse engineer a business vision that's going to support that, now you're creating something that can be truly meaningful, right? So this is the business vision component to that. So I'm gonna talk about personal vision for just a hot second, and then we're gonna be done with that because I want to get to the financial literacy piece because this is so incredibly important. When you get to the personal vision, I want you to think of like, what could you write for your 100th birthday speech? Let's pretend you're turning 100 years old. And I just want you to think, like, who would you want to be there? Who would you want to be in the room? And what would you say? What are the things that you would say to the people there? And like, what would be the message that you would want others to carry outside the room when you were done talking? Those are the important things to consider when putting together your 100th birthday speech. The other thing I want you to think about is, and you might think, well, come on, man, like I'm in my 20s or I'm in my 30s, or what, my health is great. I'm going to be lucky to make it to the next decade, let alone, 100. Okay, fine. And that is something called future self discontinuity. So in other words, you view your future self almost like a stranger. Like you don't even know or recognize that person. Okay, fair enough. Let's look at the next milestone for you. Let's say that you just turned 40. You just say that you're 42, and maybe the next milestone might be when you're 50. Maybe the next milestone might be when your kids graduate from college or graduate from high school. Whatever that could be, I want you to think about what that next milestone is, and that way you can create a speech around that event. If the 100th birthday speech is just too far removed for you. And Sarah is sharing, take it from someone who had a stroke, take care of yourself first. Absolutely. And I'm glad you're still around, Sarah. Yeah, the world is a better place for you with you being in it. So let's talk about the 3 C's of business vision. So now that we've discussed and talked about the personal vision, right? And Sarah highlighted the importance of that because we don't know how long we have, but it is important that we are marching towards a specific point, right? Towards something, towards a vision, right? What is our relationships? What do we want our relationships to look like, and all these different aspects of our life? Now we're going to talk about business vision. And the business vision is defined in 3 C's. There are 3 C's of business vision. And those 3 C's are core purpose, core values, and client avatar. Core purpose, core values, and client avatar. The core purpose, we're going to unpack that one first. And before I move on, I just want to make sure that I make this quick point. Whenever I get hired as a strategist, right, whether I'm a strategist or a CSO, chief strategic officer, from a fractional perspective, and I am invited into different entities, different businesses, and I come in, it's interesting that when I look through the lens of their company, I'm looking at their entire company, I'm looking through their company through these 3 lenses. It's interesting how I see glaring gaps in what's going on, and they're usually in one or more of these areas around core purpose, core values, and client avatar. And it will demonstrate itself. It will show up as you might have a lot of turnover with your staff. You might have not a great company culture. You might have a lot of trouble attracting buyers and attracting leads. You might have trouble attracting good talent, right? Good workers. That's what I mean in terms of talent. And these are the sorts of things that you have to start to consider. If you're having trouble in those things, it's going to be probably in one of these 3 areas, if not all 3. All right, so let's unpack that. Let's look at core purpose first. Core purpose is specifically what business that you're in and what problems do you specifically solve. And it's really important that you be highly specific in your answers. So I want you to think about this. When you're thinking about your core purpose is really going to be, I run into this a lot, especially with solopreneurs who have this idea that they feel like they need to be in 50 different businesses all at one time. And the problem with that is, let's say you got all these different ideas, like, yeah, I'm a serial entrepreneur. I've got all these different businesses going on. I'm like, okay, are they true businesses? Are they running without you? Meaning, like, if you don't show up to work, that this thing is still going to make money. Because if not, all you have created is a job, not a business. And I'm just saying, I'm not suggesting that that job isn't worth doing, but you don't have 7 different businesses. You are one person that does 7 different things. And that's a very, very different standard. So why this is relevant to the core purpose is because think about it. Think if someone shows up, right? Like if you, let's say you have a heart surgeon who also delivers pizza. Okay. Like you're like, okay, didn't you deliver my pizza on Saturday and you're going to be cutting in and working on my heart on Monday? You're like, yeah, I just make a little bit extra money on the side. I'm like, really? Like being a heart surgeon doesn't pay well enough? You have to deliver pizzas on the side, right? Like how much are you really going to trust that heart surgeon? Probably not that much. I know I wouldn't trust. I mean, I'd be like, I mean, if it was my last resort, maybe, right? And this is what happens when I see people who they get into the insurance world and they start selling life insurance. And then they decide, well, in addition to that, I'm going to start doing some wholesaling in real estate. And in addition to that, I'm going to start selling some essential oils and some other MLM on the side here. And you've got all these different, you're so fragmented across all these different things that when people reach out to you, they're like, oh my gosh, what are they going to try to sell me? Or what hat are they wearing? They're not aware of it. They can't read your mind. And this is what I see when people just hop from one thing to the next, to the next, to the next. It gets very distracting for people who really don't know what you're representing. And it's interesting because I have made very distinct shifts in who I was, like who I am. But in my local town, and Sarah is in my town, I am known for real estate. That's where most of my money comes in. I'm known specifically for real estate. So anytime people have a real estate question, a lot of times they're reaching out to me with real estate related questions because that's what I'm known for locally. And it's like no amount of marketing is going to change that. So I really don't market locally for what I do as a strategist. You know why? Because it'd be like pushing a rope uphill. So that's why you have to think about this. Now, does it mean that I don't still answer real estate questions or have, do stuff nationally different? No, I don't, or do stuff different nationally. No, it's just, I want you to understand that when you occupy that space in the mind of people, it's really hard to change that. For some people, I'm known as Mark the Marine, right? Because I spent time in the Marine Corps and I did some stuff for a nonprofit for a little while, and I did some other things, and people will forever know me as that, right? So I occupy that mental real estate for people, as a Marine, and as stuff that I did, not so much when I was in the Marine Corps, but when I was outside the Marine Corps. So people know me for that, right? So it's just interesting how people kind of put you in that box, like, oh, that's the guy who, or that's the gal who, right? So if you're coming to them with all sorts of different core purposes, it's very confusing for your avatar. Now, again, I'm making this point here specifically around financial literacy. But this is incredibly important, especially if you're struggling with growth in your business. Okay. So I just want you to think about that. When it comes to core values is what matters to you in this business. And not only what matters to you in this business, but how would the world be worse off if you went out of business? That is very, very important. Because if you're thinking about how would the world be worse off if you went out of business, because your business is just an extension of you. So how you operate in your life is extremely important to how you're going to operate in your business, right? You don't want to create a business that you don't want to go to every day because you would hate it. So that's one of the main reasons why when you're starting to define your core values, you start to recognize that your business is just an extension of you. So think about the things that are your core values. And the way you think of that is you might say, okay, well, what are some things that I value? Okay, I value peanut M&Ms. Am I going to go to a war over peanut M&Ms? No. Someone breaks in like, give me all your peanut M&Ms. I'm like, dude, I'm not going to tackle you to save my peanut M&Ms. They don't matter that much. Take them, right? But someone comes into my home and threatens my family. that's going to be bad for them. Like in every way, it can be bad for them because that represents a core value of mine. So where I would say is where the line of demarcation is when you're willing to get up off the couch to act on something, that's how you know it's a core value. When you're willing to take action on something that's a value, I would argue that's a core value. So have you ever had a friend that was wandering off the reservation and you just were not willing to follow them? That's because it violated a core value for you. You were willing to blow up the relationship to basically because it violated a core value for you. Okay. So think of those excesses, the really, really good things and the really, really bad things. Think of those excesses in terms of how those represent core values for you and how that could translate perhaps into a core value for a business, right? So think of it that way. So now we've talked about core purpose, we talked about core values. Now let's talk about your client avatar. Your client avatar is who specifically and ideally do you want to serve? Who specifically and ideally do you want to serve? So when you're thinking about this, I want you to think about these people in terms of geographics, demographics, and psychographics. Geographics, demographics, and psychographics. This is straightforward. Geographics is where they are. Demographics is who they are. Like, are they married? Are they single? Are they old? Are they young? Are they middle-aged? Are they educated? Are they poor? Right? Or are they educated? Are they not educated? Are they rich? Are they poor? Whatever. Like, I want you to think about that in terms of the demographics. Then you're also going to think of them from their psychographics and their psychographic profile. So think about how they think and how they buy. It's important you think about how they think and how they buy. When you're considering psychographics, I want you to think of the acronym ALIA, A-L-I-A. I want you to think of their attitudes. Their attitudes, their lifestyles, their interests, and their aspirations and goals. So when you're thinking their attitudes, think of things like, okay, what's their attitude on life? What's their attitude towards education? What's their attitude towards social media? What's their attitude towards, living in the world today? Whatever it is. Right? And anything that's necessarily relevant to your product or service, that's important. So if they have an antagonistic relationship with, like say, for example, someone is a massage therapist and other people might say, oh, that's just weird. You're like, really? Tell me why you think it's weird. I don't know. Like, I just don't think about getting naked in front of a stranger. Like, you don't have to get completely naked in front of, a massage therapist if you don't want to. You can leave your clothes on. Oh, really? I didn't know that was an option. Yeah, absolutely. You'd undress to your level of comfort. And they're like, oh, well, that's cool, right? I didn't think about that. Because like, if, you might be someone who, when you take off your shirt and it looks like you're still wearing a sweater and you are self-conscious about that, right? You could say, no, leave it on. In fact, please leave it on, right? But my point is, it's important that you would educate that individual, right? And start thinking about the things that are important to them. Okay, what are their attitudes? What's their lifestyle? So when you're thinking of their attitudes, also it's important you think of their lifestyles. Are they a young, jet-setting, type of, where they don't have any kids, and they call them, what do they call them? Dinks, dual income, no kids, right? Which just sounds very bizarre. But if, is that their lifestyle and they travel around a lot and they go on lots of vacations, or are they older and they like spending more of their time with their grandkids? What is their lifestyle like? Think about their lifestyle. What are their interests? Their interests are very important to think about and consider when you're thinking about, are they into NFL football? Or are they into European football? Are they into NASCAR? Or are they into Formula One? Whatever that is, it's important that you think about their interests, because if you can tee up with their interests, that's also going to be really, really important. So you start thinking about different interests that they have, and and things that are going to be that are important to them. Then you can start to say, okay, well, these are the things that are important to me, and then you can start sharing that with them. And if you guys have shared interests, it's much easier to reach them in your marketing. The last piece there is your aspirations and goals. If you know someone's aspirations or goals, it's going to be far more easier for you to reach them in your marketing. And again, from a financial literacy perspective, this is going to be massively easier for you to reach them if you can say, hey, look, these are your goals. Okay, cool. Let me help you get there much faster. So that's going to be really important for you to understand in terms of your avatar. So those are the 3 C's of business vision: core purpose, core values, and client avatar. And that is the vision. Let's put the fries in the bag on vision, and we'll go from there. So, yeah, I see a few more people have joined. So just let me know where you're from and what kind of business that you're in, so we can make this relevant to you, because we're talking about financial literacy here. And the whole point of this is really being literate in from a business owner perspective. I'm not trying to make you into an accountant. I'm not trying to make you into a bookkeeper. That is not the point here. The point here is to make sure that you can be just, what you need to know, so but you can still be good at the other things that you need to be good at, whatever operational function that you're in. So when we talk about infrastructure, we talk about vision, then let's talk about infrastructure. Infrastructure is the bones of the business. It's things like the desks and the chairs and the software and the computer systems and websites and things like that. And you might be thinking, like that sounds kind of important, right? To have the infrastructure built out in your business. And it is. It's absolutely critical to have good infrastructure in your business. But this is where you start to think about, all right, well, if you're thinking about, when you're looking at your infrastructure, you have to think about your infrastructure. Sorry, hold on. My slide is doing something weird. Okay, there we go. So when you're thinking about your infrastructure, it is important that you think about your infrastructure in the context of why is infrastructure so important? Well, vision has to come first, because you're going to be building an infrastructure that's in alignment with that vision. Because again, if let's say Sarah's vision is to lay on the beach in Spain, rubbing cocoa butter on her belly for 2 months out of the year. Well, if her vision is to lay on the beach and she creates an infrastructure that requires her to return emails and phone calls in a timely manner, that's going to be a horrible experience when she's trying to lay on the beach for 2 months out of the year, rubbing cocoa butter on her belly. Fair enough? So I just want you to understand that's really critical. You have to think of those things from that perspective. So we're not going to spend a heck of a lot more time on this. I just want to get through the rest of these. But when you're looking at process is simply how you do stuff. And you look at that from the perspective of both tactical and strategic. Tactical is just your day-to-day, LOL. Your process is your tactical day-to-day stuff and how you do things, your standard operating procedures, your checklist items, just your day-to-day stuff, right? How you answer the phone, how you prepare bank deposits and things like that. The strategic planning part of this is think of that like you've built this system, you've built this battleship. Now you want to take the ship out of the harbor, and that takes strategic planning. You want to go make some trouble. All right, fine. So that takes 3 components, and that's people, purpose, and promotion. The people is you start thinking from a strategic perspective of who you're going to need. Are you going to need people outside the organization? Well, probably, especially if you're focusing on on launching a new product or service. You're probably going to be going after a new client base. That makes sense, right? Who are those people that they represent? You might need help from an inside perspective. You might need to hire additional folks, or you might need to bring on some subcontractors or new vendors or new suppliers, right? Think of that from the people perspective. From a strategic purpose, this is where you're thinking, okay, well, what is the strategic purpose that you're trying to accomplish here? Are you trying to grow your market share? Are you trying to expand into a new market? Are you trying to vertically integrate into an existing market? Maybe you're launching a new product or service. Whatever the strategic purpose is, it has to be in alignment with your core purpose that we talked about in the 3 C's of business vision. Because if it doesn't, if your strategic purpose isn't in alignment with your core purpose, that's how people start to wander and get that shiny object syndrome, right? It would be as if Starbucks started selling chainsaws. It doesn't make any sense. So this is why it's important for you to stop and think about this, where does your strategic purpose still align with your core purpose? And if it doesn't, you really need to be questioning if you should be doing it at all. So that last piece is promotion. Promotion is just communicating a lot, right? Imagine if you have a teenager at home. You're going to be repeating yourself quite often. And that's what promotion is. It's not just telling the world and promoting and with advertising and marketing and networking and all of the promotional things and saying the same message a lot of different times. It's also promoting it internally to your staff, to your employees, to your vendors, to your suppliers, to your subcontractors, and making sure that everybody is in alignment so that when it times come to scale, everybody's ready. Okay, so we talked about that. Let's talk about execution. Execution is really, this is such an important perspective in the Viper framework because so many things fall apart in execution. And this is one of my favorite quotes by General George S. Patton, is a good plan violently executed now is better than the perfect plan executed next week. I know so many people wait for things to be absolutely perfect before they actually move. And life just doesn't line up that way. It rarely does. So I just want you to think about execution. And the reason why, again, like I said, most plans fall apart in their execution. And the reason for that is because I know too many business owners that have way too many priorities on their to-do list, right? They have that to-do list of 37 items they're going to try to get done today, right? And this is the problem, is because they have way too many priorities. And having too many priorities has the same impact as having no priorities. So that is why I like to look at my activities based on what's called the daily 5. The daily 5 are up to 5 highly specific actions that you can take, which will move the needle towards your vision or your strategic plan, one of the two. And that's why I'm saying up to 5. For me, it's daily 3. I really like 3 things to do, because if I'm trying to do 5 things every single day that are going to be moving the needle, I get burned out. I get worn out too fast. So for me, I like 3. 3 is a very manageable number. And I'm telling you, if I can get 3 things done every day, it's way better than getting 5 things done one day, nothing done the next day, and then maybe 1 thing done the day after that. I'm so fragmented, I'm not getting any real traction. But 3 every day, I can do that. I can do that all week. Okay. So I just want you to think about that in terms of the daily 5. This last piece is reporting. Reporting is around lead metrics and lag metrics. Lead metrics are just based on your actions and activities. It's just measuring what you did. It's just measuring your actions and activities. So again, this right here is an action and activity, right? This is one of my daily 5. This function right here that I'm doing, this is part of educating others and letting people know what it is that I do. The lag metrics are the results of those activities. That's new subscribers. That is new people signing up for different courses. That's maybe people trying to hire me as a strategist, whatever that is, right? Those are the results. I don't have any direct control over the results. I only have direct control over the actions and activities. So I want you to remember that. I want you to keep that in mind, because if you're trying to keep, if you're trying to get the results that you want, sometimes you just go, man, I'm not getting the results I want. Okay, what actions and activities are you taking? I think people far too often, they look at the results that they're getting and they get frustrated. I'm like, okay, look at your actions and activities and adjust. It's pretty straightforward. So that is the Viper framework: vision, infrastructure, process, execution, and reporting. All right, so we're talking about, that's the Viper framework. Again, we're talking about financial literacy. So let's talk about the 4 core functions, and we're going to tie this into the financial literacy piece here in just a second. So again, for those of you who just joined, please let me know where you are from and what business that you're in. And that way I can make this relevant to you as well. So thanks for hanging out today. The 4 core functions of business have to be true in every single business. So let's look at these 4 core functions. They are lead generation, sales, operations, and accounting. And your customer's journey through your company happens in that order. First lead generation, then sales, then operations, then accounting. And that's really important to think about that when you're viewing these folks. Sorry, hold on one second. When you're viewing these folks and you're saying, hey, where did you come from? And you're realizing how they're coming through and how they're experiencing your company through your lead generation, and then through the sales process, and then through operations and fulfillment, and then finally through the billing and the accounting. That's really important to think about that in terms of your customer's journey. And when it looks to, the reality is this: when you're looking at your lead generation function, everything has to support your lead generation function. Everything. Because this is the reality. You can have the best, most efficient business. You can be an absolute paragon of virtue. Your sales technique so dialed in that you could sell ice to Eskimos and voting booths to Castro, and you can still starve. So you can never, ever, ever, ever take your foot off the gas when it comes to lead generation. You just can't. Because I don't care, you might be rolling in it, but if your leads dry up, you will starve. So that's really important that you consider that. And that's why, from the financial literacy perspective, you have to stop and think about this. You have to have that money always flowing into your lead generation function. Otherwise, you're gonna, like, it's like running out of air, right? If you're not paying attention to where your air is coming from, you're going to run out of air, and the whole unit will die. So this is why you have to make sure you're focused on that. Once you're with that lead generation function and that engine running, then you've got the sales function. And the sales function just continues the conversation where the lead generation leaves off. If I had to pick which of these two I had to be really, really good at, it would be lead generation. If I'm really good at generating leads and I have a lot of people coming into me, I don't really even have to be that good at selling. Does that make sense? I don't really have to be that good at sales. I mean, if I have 100 people coming to me, chances are I'm going to land probably 10% of them, right? And if I had 1,000 leads coming in, again, I'm probably going to have more than I can handle. So this is why I'm saying you have to look at this from a lead generation perspective and then walking that into a sales conversation. And that's just continuing the conversation that started in the lead generation. And it's understanding that effective selling is not about holding people's heads underwater until they say yes. It's about finding effective solutions. So that's the sales function. The next is operations. If you're going to get stuck, generally you're going to get stuck in the operational function. And that's if you're like, let's say that you're a chiropractor, you get stuck doing chiropractic. If you're a dentist, you get stuck doing dentistry. If you're a website maker, you get stuck making websites, right? That's generally that's generally how the operations role works for a lot of business owners. And the last one is accounting. So we talked lead generation, we talked sales, we talked operations, and we talked accounting. Accounting is generally, it goes like this. If you're going to ignore something, generally you're going to ignore the accounting. And it sounds like this. Well, I've got more money in my bank account this month than last month. I must be doing okay. And that's generally how it happens. So I want you to think about that. You have to focus on the accounting function. And this is the truth, is the accounting collects the money. If you're doing this for money, wouldn't it make sense to actually have an accounting function that's being paid attention to? I mean, it stands to reason. Accounting function, it helps pay the bills. That's important. Otherwise, your vendors are going to cut you off or your creditors are going to cut you off. The accounting function also tracks and measures everything that happened. And that is so important. And that's for those of you who identify as not being a numbers person, that's fine. I get that. But it all the numbers are is it just represents what happened. That's all it is. It's just like the scoreboard, right? You look up and you say 49 points on the American football scoreboard, and you go, oh, 7 touchdowns, right? Like, it's not hard. It's easy to figure out what happened. And that's why I'm saying it just tracks and measures everything that happened. But what I'm about to reveal is probably the most important thing about the accounting function, and that it forecasts and it budgets and it helps you plan for what will happen or what might happen or what even you hope doesn't happen, right? But you can plan for these sorts of things. And that's the real true strength of the accounting function. Not just what happened in the past, right? That you can't change anything that happened in the past, but you can plan and prepare for the future. And that is one of the things that the accounting function that people just don't pay attention to. And I think that they're doing it at their own peril. So what I want you to think about here is, from these 4 core functions, are these things the same skill set? Lead gen, sales, operations, accounting, are they the same skills? No, of course they're not the same skills. That's why you have to bring in people that are in alignment with what? That are in alignment with your core values. That's right. We talked around again, the 3 C's of business vision. I know it keeps coming back around like a bad penny. This is why you have to have people who are in alignment with your core values that you're going to hire and do those things for you, do these functions that you're not great at, so you can focus on the deliverable and being good at what you're great at. So we talked about the Viper framework. We talked about the 4 core functions. Now let's talk about the financial statements. Now the financial statements, again, don't get freaked out. This is not going to be difficult. I just want you to understand where I'm going to walk you through this. It's going to be pretty straightforward. Financial statements, there are 2 main financial statements. The first one is a balance sheet, and the second one is an income statement or a P&L. Now, I want you to understand, when someone says an income statement or P&L or profit and loss, they're all the same thing. They're all exactly the same thing. There is nothing different between an income statement, a P&L, or a profit and loss. They're all the same thing. It's just vernacular. I'm more of an accounting purist because that's my undergrad. And I have an undergraduate degree in accounting, and I always knew it as an income statement. So I never really called it a P&L. But again, when they say that, they are saying the same thing. So the interesting thing here is the balance sheet. There's two key differences in terms of timeline when it comes to balance sheet and income statement. A balance sheet is for a very specific point in time. So if I ran my balance sheet today, right here in this moment, I would have a certain set of numbers. Okay, I'd have certain balances in my account. If I run it tomorrow, after a bunch of transactions have been run, if I run that tomorrow, the balances are going to be different. Okay, so I just want you to understand it's just the balances that are in all of the accounts. That's what a balance sheet is. That's all it is, right? So if you wrote a bunch of checks, and let's pretend those checks cleared right away, but let's just say that let's say you paid out a bunch of money. Okay, well, if the balance in your checking account changed, it would make sense that the balance sheet changed. That's all it is. Okay, so I just want you to understand, balance sheet is for one point in time. The income statement is over a period of time. So that might be your month, that may your sales and expenses over 1 month time, or 1 quarter, or 1 year. So this will make more sense here in just a minute, but I just want you to understand that those are the two fundamental things that are different about these financial statements. So again, if you are joining me, let me know where you're from. Just go ahead and put that in the comments, and where you're from, and what kind of business that you're in. So let's talk about the balance sheet. The balance sheet is made up of three basic things, and they are your assets, your liabilities, and your equity. Your assets is what is owned. Your assets is what is owned by the company. So I want you to think about what is owned by the company and what you own outright. If like you have a leased vehicle, you don't own the vehicle, it's just a lease. So that would not be an asset. Okay, so it's really important that you think about this. Like, what are the assets that you truly own? Now, if you have a vehicle that you're buying and a bank has a lien on the title, yeah, you now own it. The title is in your name. You own that asset. Okay, it might be things like checking accounts. It might be, if you got a stack of books, right? I have a couple of collector's item books that are probably worth $400 or $500, and you're like, oh my gosh, really, for a book? Yep, for a book. Okay, but I want you to think about that. Like, what are some assets that you own? And you want the balances of what those things are, in those accounts. We'll come back to that in a second. The liabilities are what you owe to others. Okay, so if you owe $50,000 on a mortgage, or $10,000 on a credit card, or whatever, those are your liabilities. Your equity is if you conceivably sold off all of your assets and paid off all of your liabilities, that's what you would have left over, conceivably. So I just want you to think that's your equity. So your assets, your liabilities, and your equity. I'm going to show you a example of a balance sheet here in just a hot second. So let's look at the income statement. The income statement is also, again, known as a P&L, or profit and loss. So let's look at this. Again, these are broken down into three areas. Remember, the balance sheet is one spot in time. The income statement is over a period of time. So the income statement is made up of revenues, expenses, and your net income, or net loss, right? If you lost money that month. So this is important when you're thinking about, okay, so your revenues are your sales. That's your gross sales. So in other words, if you sold your services for $500 throughout the day and you made $500 in sales, that's your gross. That's the total amount that you get. Your expenses are what you pay out in order to make those revenues. So in other words, if you have electricity that you have to pay, if you have rent that you have to pay, if you have marketing expense that you have to pay, those are the expenses that come out. Those are the payments that come out. And then what's left over is the net income. So for over a period of a month, let's say that you made $10,000 in sales and you paid out $7,000 in expenses, your net income would be $3,000. Make sense? Okay. So let's go through this. So the balance sheet, I'm going to take myself down to the bottom here so you can see this a lot better. But this is actually in the book, The Time Wealthy Advantage, on page 265. So if you do have a copy of the book, you can actually follow this along a little easier, but you can also see this on the screen. So when you're looking at the assets, you'll see the assets at the top, the liabilities kind of in the middle there, and then the equity is all the way at the bottom. Let's go into the assets first, which is the top part of the balance sheet. So when you're looking at your assets, what you're going to see is you've got your cash balance, and first of all, you're going to notice that they're organized from from most liquid to least liquid. What do I mean by liquid? What I mean is by what is the most convertible to cash. So in other words, if you walk into a bank account and say, hey, I want to withdraw all my cash, that's very easily convertible to cash. If you're looking at your accounts receivable, which is what people owe you, well, you might have to make a few phone calls, or maybe you could sell off your accounts receivable to get someone to buy them, but they're not going to necessarily pay you all of it. But they'll give you some. They might pay you $90,000 for accounts receivable, but realistically, with a little bit of phone calls, you're just waiting on your vendors to pay you, or you're waiting on your customers to pay you. You'll collect $101,000. The vehicle, you might have to sell the vehicle, right, to get that $29,000 back, and the same thing with real estate. So it's so you're talking most liquid to least liquid. So from a cash balance perspective, again, this is just $10,350, which is in your checking account, right? Or it could be a cumulative of checking and savings or whatever. So this is the cash balance currently in your checking account. Then you've got accounts receivable, which again is what your customers owe you. And that total amount, that balance as of this moment, is $101,275. You have a vehicle as an asset. Now, vehicles and real estate, they're a little bit different from an accounting perspective, as these are listed at what's called book value. And book value, it doesn't mean like Kelly Blue Book value or anything like that. It means specifically what did you buy it for, and then it goes on your balance sheet for the purchase price, which is, I know, a little misleading, because if you hold this van for 3 years, it's probably not going to be worth anywhere near $29,000 anymore. So I get that, but I'm just letting you know that is generally the accounting rule. Okay. So from that side, you've got $29,970, which was the book value. So again, we're talking about financial literacy here. Okay, this is about getting used to what a balance sheet is. It's a basic balance sheet. The real estate side of things is also what you need to be looking at. This is again based on book value. So that is $275,500, which is what you purchased it for. So the total amount of the assets is $417,000 added all together. Okay, so that is what I want you to think about when you've got your assets. When you're thinking about your assets, your total assets. All right, so that is everything with the balance sheet on the asset side. Now let's look at the liability side. The liability side is, now you've got this at the bottom section of the liabilities. And this is where you're looking at your credit card balance. Again, this goes from shortest term debt to longest term debt. So your credit card balance, maybe you have a Chase credit card of $34,760. You have accounts payable, which is due to your vendors, right? So again, they're selling to you on credit. So you might owe your vendors $37,500. Your Wells Fargo van loan, right? You took a loan out to buy the van. You only owe $11,570. And of course, you got a mortgage out on that piece of real estate, which is down to $105,350. So the total liabilities is $189,180, and your total equity is $227,915. So that is the assets minus the liabilities, which equals the equity. Okay, so it's really important you understand that. So any questions on this so far? This is now let me just tell you, this is a pretty basic balance sheet. So I just want you to understand where I'm coming from when you see this. Okay, so this is not super complex, and this is it. Accounting is just about rules. It's just, as long as you understand the rules, it's pretty straightforward from there, right? And that's a basic balance sheet. So from a balance sheet perspective, we'll put the fries in the bag on that one, and then we'll move forward. So when you're looking at your income statement, the income statement of your revenues, your expenses, and your net income. Your revenues, expenses, and your net income. If you're looking at this, again, this is also out of the Time Wealthy Advantage. You can go to find it on page 267. We're going to look at the top section, which again is revenues. The middle section is expenses, and the bottom section, which is your net income. So again, if you're trying to have this and understand the financial basics, again, I know this is going to be a really basic example, but this is really critical. And for some of you who may already have this kind of figured out, I don't want you feeling like, well, I already know all I need to know about this. Like I don't really need to go. Yes, but understand you got to know the basics before you can go on to the more advanced stuff. So the income statement, we're going to say that this is over a period of 1 month. We're going to say this is over a period of 1 month. So let's look at the top line revenues there for just a second. So the top line revenues, when you're looking at this, you've got product sales and service sales, which equals total sales of $114,000. So you might see the percentages off to the right, which is it does confuse some people, but that is your percentage of sales. So your percentage of sales. So when you're looking at your percentage of sales, so hold on 1 second, guys. Sorry, 1 second here. So this is when you're looking at your sales figures, I want you to think of you've got your revenues of 114,000. Well, 114,000 divided by 114,000 is 100%. Okay. So if you're looking at your product sales, it's 75,000 divided by 114,000. That is 65.8%. So that is 65.8% of total sales. Why would you care about that? Well, you might know intrinsically that, well, product sales has higher margins, for example, or maybe service sales has higher margins. I don't know. But let's say that product sales has higher margins. So you want to push product sales as much as you possibly can. Okay. And like, hey, if we get above 60% in product sales, we're going to have really, really good months. Okay. And or whatever. Like you can know these things by dialing into the financials. So that's what's really important. So we'll come back to this in just a second when I'm going to start revealing to you how to do what's called a percentage of sales method when you're looking at your income statement. So let's look at the total expenses. So we looked at the revenues at the top. Now we're going to look at the expenses on the bottom. The expenses are, you've got raw materials of 34,000. Insurance expense, 5150, interest, 2450, commissions, which is paid out to your sales agents, wages, 44,970, for total expenses of 96,320. Your net income is, again, your revenues, your total sales of 114,000 minus your total expenses of 96,320 to equal net income of 17,680. So this is important. So this is where you're like, oh, so I made $17,680 in the month of whatever, say December 1st to December 31st, or January 1st to January 31st, right? So it's over that period of that month, or this could be over a period of a quarter or a year or whatever, right? So however you run these numbers, and of course it'll capture all of those from that perspective. Okay. So that is your income statement. So you might say, okay, great. That's great, Mark, but what does this have to do with the price of the price of tomatoes? Why does this matter? Why should I care? Well, let's get into the actual growing, like, hey, dude, where's all my cash? And this concept of growing broke. You cannot be strategic if you do not know your numbers. You cannot be strategic if you do not know your numbers. And this is why I'm saying, like, in order to be strategic, you have to know and be able to plan using several different metrics and avoid growing broke. So let's talk about that. These are 3 key metrics that I use. But are there other metrics? Yes, of course there are other metrics, but these are just 3 that I'm going to expose you to right now. The first one is called profit margin percentage, and this one I'm showing you first because you have to be on this like a freaking Band-Aid. You can't take your eye off the ball when it comes to not watching your profit margin percentage. Then there's also cash balance history, and then your cash as a percentage of sales. We're going to show you first and foremost the profit margin percentage. So let's get into that. So what you're going to do, again, let me take myself down here for a second. What you're going to do again is you're going to look at that column on the right-hand side, that far right-hand side, which is these are your cash, or I'm sorry, this is your percentage of sales method, your percentage of sales. That's what I was trying to think of here. So when you're looking at your percentage of sales, let's look at your revenues. Again, we talked about this here, where you're looking at the percentage of sales, where you see the 75,000, you got 65.8% of sales, and 39,000, which is 34.2% of sales. You're dividing those numbers, the 75,000 divided by 114, which is 65.8, okay, respectively. Now we're going to be looking at these numbers here, and this is the number that I'm going to be paying attention to, is that number down there on the bottom, that net income percentage. Now, I'm going to just demonstrate this to you real fast because this is the sort of thing that when you're talking about like fractional CFOs, and these are people who get paid a lot of money to pay attention to your finances, and this is a main tool for them. And it's not the only tool. They have lots of tools, but this is a main tool for them. And I'm telling you, they are worth their weight in gold, because what they're doing is they're looking at the trend, but they're not looking at the number, right? So in other words, let's say for argument's sake that you had $200,000 in sales in 1 month, okay? And your wages were $100,000, okay? So as a percentage of sales, your wages were 50% of sales, okay? 200 divided by 100, right? So basically you had 50% of your sales were paid out to wages, which is probably not that crazy because wages are always the highest number. So let's say that you went to $400,000 in sales, okay? But you would expect your wages, or I'm sorry, you would also expect your wages to go up, right? Because you sold more, you probably worked those people more hours. Well, maybe they worked a little bit overtime. And you might be thinking, okay, yeah, that makes sense. So you see the number, the raw number, you're like, yeah, my sales went up to 400,000. Isn't that amazing? And my wages went up. My wages went up to 300,000. You're like, okay, well, I still made 100,000. That's a lot. Yeah, because if you divide the 300,000 divided by 400,000, that's 75%. Now you're comparing apples to apples. You're not looking at just the raw numbers. The raw numbers don't tell you much, but the percentage of sales tell you everything. It says, dude, this one over here, you were paying 50% of sales out to your wages. And this one over here, even though you sold more and your sales literally doubled, your wages more than doubled, right? Like they went to 75% of sales. Dude, you're paying out way too much in overtime or something, or people are just working way too slow. Like maybe they're getting burned out. But something's going on where you're making your business is less efficient. So it's an efficiency measure. So it's really important that you utilize this methodology in analyzing your books. Okay. So just think about that. Again, watch us again on YouTube, watch us on replay, and you will understand this. But it's a very, very valuable method when you're comparing month to month or period to period. Okay. So let's get back into the nuances of this. So here we are. Now we're looking at our percentage of sales of 15.5%. That's known as a profit margin percentage. Profit margin percentage. And this is what you have to protect. So when you're looking at your profit margin percentage, this is what happens when companies grow broke. And I'm going to demonstrate that here real fast. So we got about another 15 minutes or so. So for those of you, I know that you might have to head out, but again, just hang in there. If you've got any questions, just go ahead and put them in the chat. So when you're looking at your profit margin percentage, I want you to think of this from let's say you've got a company that's got revenues of $10 and you've got expenses of $8 and your net profit is $2 and your net profit margin percentage is 20%. Okay, 2 divided by 10 is 20%. So let's pretend in this hypothetical scenario that your expenses go up by $1. So your expenses are now $9. Well, you think, well, shoot, I got to protect my profit. So I'm going to raise my revenues. I'm going to raise my prices by $1. So your revenues are now $11. Your expenses are now $9, and you still make that same $2, right? Well, that's true, but look at the profit margin percentage. What this indicates, it actually goes down. That's because your business is now less efficient at keeping dollars. That is really important to remember. Because what's happening is because it's less efficient at keeping dollars, you're still making the same $2 in profit, but you're not actually making the same buying power because that $2 now buys less things. So in order to protect and maintain that profit margin percentage of 20%, you actually should have raised your pricing to a dollar, not just $1, but by $1.20. So in this particular scenario, it would go to $11.20 minus $9 equals $2.20, which $2.20 divided by $11.20 is your 20% profit margin. I'm just telling you, you have to be on this like a freaking Band-Aid. You cannot let up when it comes to monitoring your profitability and your profit margin percentage. And this right here is how companies grow broke. They don't raise their prices enough. They don't raise their prices fast enough. And they're like, well, I've got good customers. I don't want to do that to them. Okay, well, guess what? If you don't do this well, they're going to be finding someone else because you're going to be out of business. And this is probably one of the number one reasons. I don't have empirical data to back that up, but if I had to guess, this is probably one of the number one reasons why companies grow broke. They're growing, right? They're growing their revenues. Like, hey, I'm bringing in more money. But you're like, dude, where's all my cash? Well, it's going out the door, and a lot of it's going out because of your reduction in buying power. Okay, so hopefully that makes sense for you. So let's get to the last two components, and we will be done for today. So this is, again, we talked about profit margin percentage. Now let's talk about cash balance history. So cash balance history is basically where I just basically track my cash. I'm literally tracking my cash. I'm not checking my cash. It's not like, yeah, I check my cash every day. You know, I log in, check it every day. Okay, that's checking it. Can you tell me what it was on Tuesday? Right? Like, or do you like, well, no, I couldn't. I mean, I could log in and tell you. Okay, but that doesn't do me anything. That doesn't tell me what the trend is. You know, what I'm saying is when you have a closing balance at the end of the month, and let's say it's $15,000 in your checking account, and you go to the end of next month and you're like, okay, there's 17,000 in the checking account. Okay, now I can see a trend. And that trend is going to tell me what direction things are going. To me, I always want to see my cash balance growing. Why is that? Because when you have cash, you have options. And I know a lot of business owners are like, no, man, I got to get my cash out there. I got to deploy my cash. The problem is you're not managing risk. And that's the problem. And I'm telling you, there is a lot of very, very large companies that have a lot of cash on their bank and on their bank account, right? Or on their books. So I want you to think about that. Like, okay, well, if you don't believe me, type in how much cash or cash equivalents does Microsoft have? I mean, I think it's like an 8 billion. I mean, it's like 8 billion or some crazy number. I don't remember exactly off the top of my head. It's been a minute since I looked, but look at the amount of cash that Berkshire Hathaway has. The thing is that entity is worth almost $750 billion, and 350 billion of it was in cash equivalents. That's a lot of cash. So I just want you to think about this. Like when you start telling me like, oh, why I can't have cash, I'm telling you, like the one thing you have to protect is the amount, making sure that your cash balance always grows. So otherwise you're always going to be treading water. So that is the cash balance perspective. So I always want to make sure that I'm tracking my cash balance history. The next thing is the cash as a percentage of sales. And this is a little tricky, not hard to do. Again, if you can operate a 4-function calculator, you can do this. You're just going to have to take off 2 numbers. Okay. And this is it. So this is the last piece, and then we're going to be wrapped up. So again, what we're going to do, let me take myself down again so you can see this, is you're going to take the number off of the balance sheet, which again, what you're going to do is you're going to circle that number right up the top, which is your cash balance from your checking. So you're going to get the balance sheet from the month you just finished. Okay. So if it's say December 31st, this is going to be your December 31st balance sheet. Okay. So you're going to take your cash balance of $10,350. Now, again, assuming that this is a monthly income statement, and assuming that you're on a monthly pay cycle, or you're on a monthly, service cycle for your business, let's say you're going to take that total sales number for that month, which is 114,000. And all I do, 114,000. See it up there at the top there? Okay. Sorry, I'm trying to do this very delicately. So what I'm going to do is I'm just going to take those 2 numbers and divide them. So I'm going to take that $10,000 in cash divided by 114,000, and I get 8.7% as a percentage of sales. It's my cash. Like, how much cash do I have compared to my sales? Well, I have 8.7% of cash as compared to sales. Now, why does that matter? Because what that tells me is, I mean, first and foremost, I'm going to track that. Because again, I'm not checking it, I'm tracking it. I want to know what it was. I want to see the trend. Because if my sales are going up, I also need my cash to go up. And that's really hard to do if you're growing too quickly. If you're growing too fast, you're going to outgrow your ability to generate cash, because you need cash to increase your sales, right? Generally, it takes cash to have more inventory or have more people or whatever else it is. And the thing was, like, that's where you have to pay attention to your cash. If you grow too quickly, you will outgrow your ability to generate cash for that next cycle, for that next monthly cycle. So that this operating cycle, like I said, runs every month. Some businesses don't run every month. Some businesses run once a year, like a farming operation might run once a year, or a builder might run once a quarter, right? As they finish off a house every quarter or whatever. So I just want you to think about that in terms of what this looks like. So again, the cash as a percentage of sales, that number here is going up, but just keep in mind that what this number could represent. Even though this number, the percentages are going up here, keep in mind it's two numbers. So the number could be going up here because cash is going up as a percentage of sales, which is great. But keep in mind, you could have cash that's staying exactly the same and your sales are declining, which is also going to make your cash as a percentage of sales going up. So you can't just look at that in isolation and go, well, it's going up, so that's good. It depends, right? You have to look at it and look at it in its totality. Have some discernment, develop some discernment over what it is that you're looking at to say, okay, it's not necessarily a bad thing, right? Like my cash is stable, even though we may have declining sales. But again, you want to like, is it a seasonal thing? Is it a shift in demand? Like what's going on? So you just need to pay attention to those sorts of things. All right. So that is all I have. Let's, I'm just going to make a couple final points. If you've got any questions, go ahead and type them in the chat. And I will answer those here at the end. But listen, the main point is you cannot be strategic if you don't know your numbers. And this is all about avoiding growing broke. So just a couple success strategies. Again, you got to know your numbers, and you've got to track your numbers. There's just no getting around that. It's a difference between knowing and tracking. So this is, or checking and tracking. I'm going to go ahead and give this quick, this is actually a true story. Let me take this down. This guy is actually a bank robber, and he's holding a gun at a teller right now, and he's making no attempt to disguise himself whatsoever. Except, so these two guys, they were MacArthur Wheeler and Clifton Earl Johnson. They robbed two banks in Pittsburgh at gunpoint with no attempts to disguise themselves whatsoever. And they thought it would be a really good idea to cover their faces in lemon juice. And they were so convinced that that would make them invisible to security cameras, like lemon juice, like an invisible ink. Yeah, so that's what they thought. So this started down this path with these two researchers named Dunning and Kruger about this whole concept of false confidence. And I see this happen with business owners a ton, where they think like, oh man, how hard could it be? I'm going to get into this business. I'm going to make a ton of money. Like, again, it can't be that hard. Well, that's what these two researchers realized, that there's a relationship between confidence and competence. So everybody at the beginning starts down here where they don't really have much confidence, and they really don't have much competence. But as they start out, that confidence skyrockets right in the beginning, and it goes up so fast until what they call the peak of Mount Stupid. Okay. And this is all of a sudden where they start to realize, oh my gosh, this is going to be a lot harder than I thought. Let's go ahead. We're going to keep going, but then it starts to crash down really, really fast until they get into the valley of despair. They're having this crisis of confidence. Now, granted, look where they've advanced a little bit on the competence scale, right? They learned a little bit, but this is unfortunately where a lot of people give up. And they don't translate what they've learned into the lesson. But if they keep going, if they keep working on their competence, if they keep learning and growing, they head up that slope of enlightenment until eventually they get to the plateau of sustainability, and where they have lots of confidence. So here's the thing. It's important to have a support system. And that's what I'm going to offer you guys for no cost. If you want to join me on Strategic Boardroom, I'm going to go ahead and put the link in the chat where you guys can join, and feel free to join me there for absolutely no cost. As of right now, I will be bringing that to an end where I'm going to start charging for memberships, but anybody who gets in now will be grandfathered in terms of just being in the community. So I'm going to go ahead and put that in the chat and take a sip. And if you guys haven't asked any questions by then, I will land the plane. All right. Well, I don't see any questions, everybody. Thanks so much for sticking around. I really do appreciate you guys, and I'm really happy. This is one of the things that I really love. So if you've got any questions around this and you want to ask, if you just want to ask me, you can go on You can go on the school community and just start up a chat with me and just ask me specific questions. I promise I'll get back with you. Or you can open up a conversation inside the room with other like-minded business owners. And it's really cool. Just a really cool place for you guys to learn. And that is all I have, everybody. Thanks so much for sticking around. I'll see you guys in the boardroom.